If you're doing a SIP in market weighted index, that's exactly what you're doing. Let me explain why this seemingly safe investment strategy could be working against you. There's an inherent flaw in the way the market weighted indices are structured. The weight of a stock in the index is directly proportional to its market cap. And what is market cap? Market cap is nothing but the share price multiplied by the free float shares available in the market. So what happens when the stock price goes up? Its market cap goes up and the weightage of that particular stock in the index goes up at the next rebalancing. So in simple terms, expensive stocks or high priced stocks tend to have greater weightage in the market weighted index. Wait, doesn't that sound like momentum investing? Yeah, because it is. Market weighted index are nothing but a kind of momentum investing. And this essentially means stocks which have done well recently tend to be part of the index or have more weightage in the index, and stocks which have not been doing well tend to have lower allocation in the index. Well friends, that's the exact opposite of buying low and selling high. You end up buying stocks at higher prices and tend to ignore stocks which are available at much cheaper prices. Let's say the stock belongs to a cyclical industry. So during the downturn, you buy less of them because the price is low. And again, when the cycle goes up and it's on an upturn, you tend to buy more of that stock, whereas you should be doing the exact opposite. This is where it gets bad for retail investors like you and me. When we do a SIP, we expect to do a rupee cost averaging. When we SIP into a market weighted index, are we really doing the rupee cost averaging? Sadly not. SIP and market weighted index are supposed to do different things. SIP is supposed to do rupee cost averaging for you, and market weighted index is like a momentum. So your more pricey stocks have more weightage in the index. So they are like an oxymoron. They are acting in opposite directions. Now let's look at some real life examples. In 2001, you would be overweight on IT stocks right before the Dotcom burst. And in 2008, you would be overweight on all your banks and lending stocks along with real estate stocks, which all crashed because of the subprime crisis. And this is the problem I have with market weighted index, in that it does not have the concept of value inbuilt in it. And this does not bode well for retail investors like you and me. I hope by now you are convinced that blindly sipping into a market weighted index might not be the most ideal way to build wealth. Unlike market weighted index, equal weighted index gives same weightage for each stock in the index. Let's take the case of Nifty 50 equal weighted index. Each stock will be 2% in the index. The stock price is immaterial, the market cap is immaterial. It gives 2% weightage irrespective of whether the market goes up, down, or whatever. Sounds good in theory, right? Let's check out in reality what happens. I backtested the returns for the last 7 years for these two index funds, the equal market index fund and the market weighted index fund. The AMC names are not important. For a lump sum investment, both did not make much difference, though the market weighted index slightly outperformed the equal weighted index by not much, but still. But the surprise was in SIP. What do you think would have happened? You still have time to enter that comment. For the SIP investment, I took 10,000 rupees per month for 7 years in both equal and market weighted. And here is what I saw. The equal weighted returned 16.51 lakhs over 7 years. Do you know how much a market weighted returned? It was 14.87 lakhs. So equal weighted outperformed the market weighted index by close to 1.65 lakhs, when you do a SIP. Same stocks, same amount, same period, same time frame, different result. What changed? Only the weightage strategy changed. Friends, equal weighted also carries much higher risk compared to the market weighted index, and the standard deviation is out there. And remember, the equal weighted was almost behaving like a mid cap index. And do you know the SIP date on which the maximum returns were seen? For equal weighted, it was seen on the 22nd day of the month. How is this related? Please check this particular video where I talk about SIP dates for large, mid and small caps. To summarize, market weighted index funds are much better for doing bulk investment and holding for a long period of time. Equal weighted funds are more suited for SIP. Remember also that equal weighted index carry much higher risks when compared to market weighted index.